All right, let's get straight to it. The U.S. markets are closed for the weekend. It's Saturday, November 15th, 2025. SoFi Technologies, ticker SOFI, ended a very volatile week with a weak finish. It closed Friday's session at $27.82 per share. That was a drop of 2.01% on the day, a loss of 57 cents. And this wasn't on low volume. It was a heavy session, trading over 87 million shares, well above its 64 million share average. Now, the common expectation, especially if you just glanced at the headlines, is that SoFi is on top of the world. It just hit an all-time high of $32.70 earlier in the week, fueled by a spectacular earnings report and a major new product announcement. The reality, looking at this $27.82 close and that high-volume reversal, is that the stock is now in a critical battle. The run-up was euphoric, but Friday's action felt like profit-taking, and it shows that the path to new highs is going to be a fight. The question everyone is asking is whether this is just a healthy pullback or the start of a more significant correction after a massive run. Let's understand why the expectations were so high. The last 3 weeks for SoFi have been a blur of good news. First, in late October, they delivered their third quarter 2025 earnings, and it was a blowout. They posted 11 cents per share in profit when the street was only looking for 8 or 9 cents. Revenue was a massive beat, coming in over $961 million, crushing the $887 million consensus. This wasn't a small beat, it was a dominant performance. This marked their 8th consecutive profitable quarter. They added over 900,000 new members, bringing their total to 12.6 million. Net income was a robust $139 million. Then, as if that wasn't enough, management raised their guidance for the entire full year across every single metric. They're now projecting over $3.5 billion in adjusted net revenue and over $1 billion in adjusted EBITDA. You simply cannot ask for a better report. Then, just this past week, on November 11th, they dropped another bombshell. SoFi announced the launch of SoFi Crypto. This makes them the first and only nationally chartered FDIC-insured bank in the United States to offer direct trading of assets like Bitcoin, Ethereum, and Solana. This is a huge move, integrating a high-demand asset class directly into their one-stop-shop ecosystem. So the expectation was, with a perfect earnings report, raised guidance, and a major first-to-market product launch, that the stock should have blown past $32 and never looked back. The reality is that even SoFi, with its flawless execution, cannot escape the broader market dynamics of profit-taking. The stock is up 136% in the last year. Trees do not grow to the sky, and traders who bought at $20 or even $25 saw $32 as a perfect place to take some off the table. This is the new tension for SoFi: flawless fundamental performance versus a stock price that has already run hard and fast, making it a target for profit-taking and short-term traders. To understand this move, you have to understand the shift in SoFi's story. For years, the market has been trying to figure out what this company is. Is it a high-risk lender, forever tied to student loan refinancing? Or is it a genuine technology company? The bears have always focused on the lending, but the Q3 report provided the definitive answer. The company operates in 3 segments: lending, personal loans, student loans, home loans; financial services, the bank accounts, SoFi Invest, credit cards; and the technology platform, Galileo and Technesis, which is the B2B side. For the first time, the non-lending segments, financial services and tech, now account for 56% of the company's total revenue. This is the inflection point. Fee-based revenue is up 57% year over year. This proves the model is working. They are successfully acquiring members with their high-yield bank accounts and then cross-selling them into higher-margin products like SoFi Invest, their credit card, and now crypto. They are no longer just a lending company. They are a diversified financial technology platform, and that's what forced the massive analyst upgrades we saw. Citigroup and Needham both slapped $36 and $37 price targets on the stock. The market is finally being forced to re-rate the company as a tech platform, not just a bank. But this re-rating also brings in new, more volatile traders, which explains the sharp two-way action we saw last week. Now, we must talk about the short-selling activity because it's a huge part of the SoFi narrative. On platforms like Reddit and X, there is constant discussion about a potential squeeze. So let's look at the facts. According to the most recent official data from Nasdaq at the end of October, there are about 110 million shares sold short. That sounds like a massive number, but you have to put it in context. This represents about 9.31% of the free float. While that's significant, it's not the 20 or 30% you see in heavy squeeze targets. More importantly, the days to cover is only about 1.4. That means, given the stock's massive daily volume, all shorts could theoretically cover their positions in less than 2 days. This is not the setup for a typical squeeze. Furthermore, the cost to borrow shares, which is the fee shorts must pay, is currently rock bottom at around 0.41%. When shorts are trapped and desperate for shares, that rate can spike to 50%, 100%, or more. We are seeing none of that. This tells us the current short positions are stable, well-capitalized, and not in any immediate danger. So what is the short thesis? They aren't betting that SoFi will fail, they are betting it's overvalued. They see a 136% run-up, a PE ratio over 50, and a company still heavily exposed to personal loans, and they believe the rally has gotten ahead of itself. They are betting that the $32.70 high was the peak of the enthusiasm and that the stock will now revert to a more reasonable valuation in the mid-20s. So if you're an investor, how do you track this? You can check data on platforms like Fintel or Ortex, but don't just look at the short interest percentage, look at that borrow fee rate. If you see it suddenly start to climb, that's your signal that pressure is building. Also, watch the fails to deliver data. We saw small spikes in September and October, but nothing alarming yet. The real story is in the F13 fillings. We can see complex options positions. While firms like Fidelity and the Swiss National Bank are buying shares, other major players like SquarePoint and Hudson Bay have large put positions, which are bets on the price falling. This is a sophisticated institutional battle, and retail investors should be very cautious about trying to chase a squeeze that the data does not support. This brings us to the future outlook. Where does SoFi go from here heading into the end of 2025? The expectation for a blue sky breakout has met the reality of a sharp, high-volume rejection from its all-time high. The bull case is simple. The company is executing perfectly. The Q3 report and crypto launch prove the model is working and accelerating. The bulls believe this $27.82 price is a gift, a chance to get in on a pullback before the next leg up to $40, driven by that new $3.5 billion revenue guidance. The risk, however, as highlighted by Friday's sell-off, is valuation and exhaustion. The stock has come a very far very fast. The bears will argue that all the good news is now priced in and that the company will have to do something even more spectacular in Q4 to justify a move higher. The macro environment also still matters. If we see any weakness in consumer credit, SoFi's lending portfolio will be scrutinized. So here is what to watch for next week. The most important signal, bar none, is the F13 fillings. The deadline for institutional investors to report their holdings from the end of the Q3 was this weekend. Over the next few days, we will get the full picture of which big funds were buying and selling SoFi before this massive earnings-driven rally. We've already seen hints from Fidelity and the Swiss National Bank who were buying big. If the final data shows a broad institutional-wide accumulation, it would strongly suggest this pullback is a buying opportunity. If we see a lot of selling, it would confirm the profit-taking thesis. This leads to my first question for you. Do you think the new SoFi crypto platform will be a major growth driver? Or is it just a risky gimmick? Comment below with your take. We also need to watch the options chain for next week's expiration. The battle between the large call, bets on price rising, and put, bets on price falling, will give us a strong indication of short-term market sentiment. The company has done its part. It has delivered record growth, profitability, and innovation. The expectation was that this would be enough. The reality is that the stock is now in a new, higher-priced weight class, and it's attracting bigger and more powerful traders on both the long and short side. In the end, SoFi's story is one of the most compelling on the market. It's a company that has successfully transitioned from a monoline lender to a diversified, profitable, and innovative financial technology platform. The expectation after their Q3 report and crypto launch was for an unstoppable rally. The reality of Friday's 2% drop on heavy volume shows that success brings new challenges, including intense profit-taking and a sophisticated short seller base betting on a valuation peak. The stock is no longer an underdog story, it's a proven heavyweight, and it's now in a heavyweight fight. Before we go, I want to hear from the investors. After a 136%